Today I have breaking news for you. The Federal Reserve has just lowered interest rates by a quarter point to 4.5 to 4.75% range. Its lowest since February 2023. And the Fed did this right after the election of Trump. Jerome Powell also confirmed his plans to stay in his role until his term ends in mid 2026, even if Donald Trump tries to remove him. So, why is this important? The Fed lowered interest rates for the second time this year to help the economy and prevent a slowdown in hiring from causing more unemployment. Until September, the Fed kept rates at a 20-year high to reduce inflation, but price increases are now closer to the 2% goal. So, this decision was influenced by slowing inflation and a weaker job market. So, what will happen to the short and the long term interest rates? More rate cuts are expected in 2025, but the exact number is uncertain due to the potential effects of Trump's proposed policies. The question is, will Trump's decision affect the Federal Reserve? And the answer is a clear yes. These include tax cuts, deregulation, broad tariffs, and large scale deportations. The full details of these plans and how soon they might impact the US economy remain unclear at this moment. Powell said it's a process that takes some time. He spoke in a press conference following the Fed's decision to reduce its benchmark overnight and lower the interest rate to 4.5% to 4.75% range. Powell said it's all of the policy changes that are happening. What's the net effect? The overall effect on the economy at a given time. That's a process we go through all the time with every administration. The Fed is trying to balance the need to boost the economy against the risk that lower borrowing costs will reignite the high inflation that took hold in late 2021. So, why is this important? Let's break down the fundamentals of interest rates first, how they are determined and how they influence your financial choices, because this will have an impact on your investments, right? In this video, we also discuss what recent rate cuts might mean for you. But first, let's cover the basics of what a rate cut actually is. And if you already feel confident about rate cuts, feel free to skip ahead, but this section may be helpful for you. So, what exactly is a rate cut? In simple terms, it's a reduction in the federal funds rate, also known as the overnight rate. This is the short-term rate at which banks borrow from the Federal Reserve. It impacts the interest rates banks offer on loans like mortgages and small business loans. When rates are high, borrowing is more expensive, and banks charge high interest rates to customers, which can discourage borrowing. It's as simple as that. So, why does the Fed cut rates? The Fed adjusts the rate to influence economic conditions. For example, if the economy is struggling, the Fed may lower rates to make borrowing easier and encourage spending. When the economy is booming, the Fed might raise rates to keep inflation in check. It's straightforward, right? Recently, we saw the Fed raise rates 11 times from March 2022 to July 2023, following a spike in inflation after the pandemic. And this was meant to slow spending and bring prices down. The federal funds rate had remained near zero from 2020 to 2022. However, Jerome Powell and the Fed held back on any cuts until inflation consistently moved towards their 2% target. Now, with inflation hovering around 2.5%, the Fed started this year to lower rates. So, now that we have covered the basics, let's look at what might happen next. Because historically, rate cuts are seen as positive for the markets, with many believing they boost stock prices. For example, we have already seen the S&P 500 tick up in recent days after rate cuts this year. But why is that? And what does the data say about this? Looking at historical data, rate cuts have generally been favorable for stocks. And here's an interesting chart that shows how the stock market has performed during each rate cut cycle since 1970. Well, the results vary. One key distinction stands out, and that is rate cuts during a recession affect markets differently than rate cuts when the economy is steady or growing. Right now, with many Americans employed and spending, it doesn't seem like we are close to a recession. If that holds, we could see the market continue to trend upward in a steady, gradual way. So, rate cuts don't always lead to reckless spending or to a market crash. In fact, according to an analysis by Schroders, the stock market has historically performed well after rate cuts. And this is important. On average, stock market returns are up about 11% in the 12 months following a rate cut, with stocks outperforming cash by around 9%. And bonds also tend to do well after a rate cut, as lower borrowing costs benefit companies, especially smaller or growth focused ones that rely on debt to fuel their business. When borrowing becomes cheaper, businesses and even individuals are more likely to borrow and invest, helping to drive economic growth. Logical, right? So the impact of rate cuts isn't always immediate. Even though the Fed reduced rates by 50 basis points earlier this year and now by another 25 basis points, it can take time for the effects to ripple through the economy. However, stock market performance is often driven by future expectations. If the market anticipates further rate cuts, those expectations are often priced in, which could explain why we sometimes see market gains even before the cuts actually take place. So, what does this mean for you? If you are investing for the short or medium term, you might consider allocating your money in ETFs ahead of rate cuts to take advantage of these expectations. And as Ben Carlson from A Wealth of Common Sense points out, the stock market cares more about company earnings than about Fed rate cuts. And I totally agree. While the stock market can do well during a rate cutting cycle, low rates don't guarantee endless upward movement, right? So, is there any change for long term investors? Not really, because what I've said in previous videos, the media and markets want you to act on this type of news. But for long term investors focused on retirement or similar goals, your strategy likely won't change much, right? So, staying consistent with dollar cost averaging into broad index funds is probably the best approach for long term investors to grow your wealth. However, rate cuts can significantly impact cash like investments because a reduction in the federal funds rate typically leads to lower yields on investments like treasury bills, certificates of deposit, and also high yield saving accounts. But what makes the situation different from past rate cuts is the broader economic and political environment, which is uncertain due to the election of Donald Trump as a president. The policies and actions that follow could drastically impact the economy, and the outcomes of these changes may lead to increased market unpredictability. So, what kind of investments do you have? Let me know in the comments below. In the next video, we will dive into 26 of the best investment lessons from Jack Bogle, a guru in the financial industry, who saw countless rate cuts over his remarkable 68 years in the financial industry. What is his advice during these uncertain times? Trust me, you don't want to miss out on this one. See you in the next video.